Retail silver is selling out. Coin shops are reporting low inventory. Online dealers are showing extended delivery times. Popular silver products, American Eagles, Canadian Maple Leafs, silver bars, are commanding premiums above spot price that have not been seen in years. Physical silver is disappearing from retail shelves right now. And yet, the silver spot price today is flat. Retail silver selling out, spot price not moving. If you have been asking why is silver spot price not reflecting what is happening at the retail level, today we answer that completely. With data, with the actual mechanics, without drama. This is your retail silver sellout complete breakdown, what is happening at dealer level, why spot price is not reacting, and exactly what this retail signal means for silver price going forward. My name is Stack AG. We invest with logic, not hype. Let us get into the data. Let us establish exactly what is happening in the retail silver market right now. Because the data at this level tells a story that the spot price completely ignores. Retail silver dealers, coin shops, online bullion dealers, precious metals retailers operate as the final link in the physical silver supply chain. They purchase silver from wholesale distributors and mints. They hold inventory. They sell to retail investors, individuals buying coins, bars, and rounds for personal possession. Right now, multiple signals from the retail silver market are flashing simultaneously. Signal 1, premium expansion. The premium over spot price for popular silver products has been rising. American Silver Eagles, the most popular silver coin in the United States, are trading at premiums significantly above their historical average over spot. The same pattern is appearing for Canadian Maple Leafs, Silver Britannias, and popular silver bars from major refiners. When premiums expand, it means retail demand is outpacing retail supply at current spot prices. Dealers cannot source enough physical silver at spot to satisfy buyer demand, so they charge more above spot. And buyers, who want physical silver, pay those higher premiums anyway. Signal 2, extended delivery times. Multiple major online silver dealers are showing delivery times of 2 to 4 weeks for popular products that were previously available for immediate shipping. Extended delivery times mean inventory is depleted, and dealers are waiting for restocking from distributors and mints. Signal 3, mint production constraints. Government mints, the United States Mint, the Royal Canadian Mint, the Perth Mint, have been reporting production constraints on popular silver coin programs. When mints cannot keep up with demand, dealer inventory depletes faster than it can be replenished. 3 simultaneous retail signals, all pointing to the same conclusion. Physical silver demand at the retail level is outpacing physical silver supply at current spot prices. Now, the question that brought you to this video, if retail silver is selling out, why is the spot price not moving? The answer requires understanding something fundamental about how silver spot price is determined. And it is the same answer we have given across our recent video series on silver disconnects. Silver spot price is not determined by retail coin shops. It is not determined by individual investors buying silver eagles. It is not determined by any physical market transaction at the retail level. Silver spot price is determined by futures traders on COMEX, trading paper contracts, in quantities measured in millions of ounces per transaction, responding to macroeconomic signals, dollar movements, interest rate expectations, equity market risk sentiment. The entire retail silver market, every coin shop, every online dealer, every individual investor buying physical silver represents a fraction of the daily trading volume on COMEX. Retail physical transactions are simply too small relative to the paper market to move the spot price directly. So retail silver can be selling out completely, with premiums exploding and delivery times extending, while the COMEX paper price sits flat. Because the paper traders setting the spot price are not watching coin shop inventory levels. They are watching the Federal Reserve. This is the fundamental structural disconnect in the silver market. Physical retail reality and paper spot price are two completely different things, determined by two completely different groups of participants, responding to two completely different sets of information. Here is the insight that most silver analysts miss completely when they discuss retail premiums. The premium over spot is itself a price signal. It is the physical market's way of communicating what silver is actually worth, relative to what the paper market is pricing it at. When you can buy a silver eagle for spot price plus $2, that tells you physical demand and paper demand are roughly in balance, normal market conditions. When you have to pay spot price plus $8 or $10 or $12 for a silver eagle, that tells you physical demand significantly exceeds physical supply at current spot prices. The premium is the market's way of rationing scarce physical supply to the buyers who value it most. A sustained high premium on retail silver products is the market saying silver's true physical value is significantly above the COMEX paper price. The premium is the gap between paper reality and physical reality expressed in dollar terms. And here is the historical pattern that makes this signal so important. Every major silver price move in modern history has been preceded by a period of premium expansion and retail supply tightness. Not always immediately, the lag can be weeks or months, but the pattern is consistent. Retail premiums expand, reflecting physical scarcity. Paper price lags. Then paper price adjusts toward physical reality, fast and significantly. The retail premium is not just a cost to buyers. It is a leading indicator of where the spot price is heading. There's a second layer to the retail silver sellout story that most analysts completely overlook, and it makes the supply picture significantly tighter than the spot price suggests. Government mints, the primary source of the retail silver coins that investors actually want to buy and hold, operate under production constraints that do not respond quickly to demand signals. The United States Mint produces American silver eagles. The Royal Canadian Mint produces silver maple leafs. The Perth Mint produces silver kangaroos. These are the products retail silver investors want. Not generic silver bars, not secondary market coins. The specific government-issued products with known purity and recognized brand value. These mints cannot simply double production overnight when retail demand surges. They have fixed pressing capacity. They have fixed plancher supply, the silver blanks that get pressed into coins. They have fixed staffing and production schedules. A production increase at a major government mint takes months to implement, not weeks. So when retail demand surges, as it is doing right now, mint production cannot immediately match that demand. Dealers deplete their inventory. Delivery times extend. Premiums rise, and the supply tightness persists for months, even after the mint begins increasing production. This is structurally different from industrial silver demand, where manufacturers can adjust their purchasing through long-term supply contracts. Retail silver investors want specific products from specific mints. And when those mints cannot keep up, the supply constraint is real, sustained, and not quickly resolved. The combination of mint production constraints and rising retail demand creates a physical supply tightness at the retail level that the paper spot price simply does not reflect. But that tightness is real, it is measurable, and it adds another layer of pressure to an already tight physical silver market. Here's how the retail silver sellout connects to everything else we have been tracking on this channel. COMEX registered silver inventory is declining. Physical silver is leaving the paper market system. Shanghai Gold Exchange is paying premiums above COMEX spot price. Chinese buyers are paying more than the official benchmark to secure physical silver. Industrial demand is at record levels. Solar, EV, and semiconductor manufacturers are consuming silver faster than miners can produce it. And now, retail silver is selling out. Individual investors are paying premiums above spot and waiting weeks for delivery. 4 completely separate layers of the physical silver market. COMEX Institutional, SGE Asian, Industrial Manufacturing, and Retail Individual are all simultaneously signaling the same thing. Physical silver is scarce relative to physical demand at current spot prices. 4 independent signals, 4 separate market layers, all pointing to the same conclusion. And the COMEX paper spot price, set by paper traders responding to macroeconomic signals, has not yet reflected any of it. When 4 independent physical market signals all align simultaneously, the probability that the paper price eventually adjusts is not a question. The only question is timing. And every week that all 4 signals persist, the pressure builds, and the eventual adjustment becomes larger. While retail investors are paying premiums and waiting weeks for delivery, smart money is doing something different. They're not buying retail silver coins at elevated premiums. They are buying silver futures on COMEX and standing for physical delivery at spot price, taking the actual metal out of the registered inventory at the lower paper price, before the paper price adjusts to reflect physical reality. This is exactly what the COMEX vault drainage data shows. Institutional participants taking physical delivery at paper prices, removing silver from the registered inventory, contributing to the tightening that retail premiums are already signaling at the consumer level. Smart money is essentially arbitraging the gap between paper price and physical reality, buying at paper price, taking physical delivery, holding metal that the physical market is already pricing significantly higher. The CFTC COT report shows managed money building net long futures positions. They are not reducing exposure as retail premiums expand, they are increasing it, because they understand exactly what the convergence of these physical signals means for paper price. This is not financial advice. Always consult a qualified financial professional before making investment decisions. The retail premium data adds a new dimension to the silver thesis that retail investors often overlook because they focus exclusively on spot price. If you're buying physical silver at retail, understand what the premium you are paying actually represents. You are not overpaying relative to true physical value. You are paying the price that reflects genuine physical scarcity. The spot price is the number that is disconnected from reality, not the premium. If you're waiting for the spot price to fall before buying physical silver, understand that in an environment of expanding retail premiums and tightening supply, a spot price decline does not necessarily mean physical silver becomes cheaper. Premiums can expand to offset a spot price decline entirely. You could see spot fall $5 and premiums rise $5 and end up paying exactly the same amount for physical silver. The most rational approach in this environment is gradual accumulation. Dollar cost average, by consistent quantities over weeks and months. Do not wait for perfect timing that may never come, while premiums tell you the physical market is already tighter than spot suggests. Physical silver allocated. In your possession. No counterparty risk. No paper claims. The actual metal that retail buyers are competing to secure right now. We do not sell silver. We do not sell anything on this channel. Anyone claiming to be Stack AG and offering precious metals or investment products is a scammer. Flock and report immediately. Retail silver is selling out. Spot price is flat. That gap between what individual investors are paying at the retail level and what the COMEX paper market is pricing is the same gap we have identified at the COMEX institutional level, the Shanghai physical level, and the industrial demand level. 4 layers of the physical silver market, all simultaneously telling you silver is worth more than the paper price admits. The paper price will catch up. It always does, because physical reality always wins over paper fiction in commodity markets, eventually. Stack AG is here every day tracking every layer of this story. Retail premiums.comex vault data, SGE premium data, industrial demand figures, .cot positioning. So you always have the complete picture before the mainstream media pieces it together. Subscribe, hit the bell. Share this with one silver investor who is confused about why retail silver is expensive while spot price looks cheap. I am Stack AG. Invest with logic, not hype. See you tomorrow.